Investing in the share market isn't as complicated as you might think. Let's start by understanding what a share market is. Picture a bustling supermarket, but instead of shopping for groceries, you're shopping for shares of companies. In this marketplace, you can buy, sell, and trade shares, which represent ownership in a company. Now, why is the share market important? Well, it's a vital component of a free market economy because it provides companies with access to capital in exchange for giving investors a slice of ownership. It's like a symbiotic relationship where both parties benefit. Companies get the funds they need to grow, and investors get the chance to share in that growth. What makes the share market so fascinating is its potential to generate wealth over time. Just as you'd plant a tree and wait for it to bear fruit, investing in shares is about nurturing your investments and watching them grow. The trick is to be patient and persistent. Consider the story of Warren Buffett, one of the world's most successful investors. He began investing in his early 20s, and through a strategy of buying and holding shares of companies he believed in, he amassed an incredible fortune. Buffett's story shows us that the share market is not a get-rich-quick scheme, but a get-rich-slowly plan. But remember, while the share market has the potential to make you wealthy, it also carries risk. Shares can go up, but they can also go down. That's why it's crucial to understand what you're investing in. Just like you wouldn't buy groceries without checking their expiry date, you shouldn't buy shares without understanding the company you're investing in. Investing in the share market is not just about making money, it's about understanding and participating in the growth of businesses, economies, and ultimately society. It's about making informed decisions and taking calculated risks. And it's about patience, persistence, and a bit of courage. The stock market can be your golden goose if you learn how to use it wisely. Ever heard of the term compound interest? It's an investor's best friend. Imagine a small snowball perched on top of a steep hill. As it begins to roll downhill, it starts to gather more snow. With each revolution, it grows larger and larger, faster and faster. By the time it reaches the bottom of the hill, it's become a massive snow boulder, far bigger than when it started. This, my friends, is the power of compound interest in a nutshell. Just like the snowball, the amount of money you invest can grow larger and larger over time, thanks to the magic of compound interest. But what does this really mean? Let's break it down. Compound interest is the interest you earn not just on your initial investment, also known as the principal, but also on the interest you've already earned. In other words, it's interest on interest. With each passing year, you're earning interest on a larger sum of money. Let's take an example. Suppose you invest $1,000 at an interest rate of 10% per annum. At the end of the first year, your investment has grown to $1,100. That's your initial $1,000 plus $100 in interest. Now, here's where the power of compounding comes into play. In the second year, you're not just earning interest on your original $1,000, you're earning interest on the full $1,100. So at the end of the second year, you have $1,210. And so it continues year after year. This might not seem like a lot in the short term, but over the long term, compound interest can significantly increase your returns. It's like a money-making snowball effect. The longer you keep your money invested, the bigger your snowball becomes. So if you want to maximize your investment returns, don't just save your money, invest it. Let it roll like a snowball down the hill of time, growing bigger and bigger with the power of compound interest. Remember, the magic key to wealth is not just making money, but making money work for you. Investing in the share market is like planting a seed. It involves risk, but it also brings the potential for a fruitful reward. Just as a farmer plants seeds and waits for the harvest, so too does an investor place their money into a company and wait for it to grow. But make no mistake, this isn't a game of chance. It's a calculated decision based on research and understanding. Now, imagine the farmer. He sows his seeds, caring for them with water and sunlight, nurturing them into healthy plants. But despite his best efforts, there's always the risk of an unexpected frost or a swarm of pests. His harvest isn't guaranteed. It's the same with investing. Even the most thorough research can't predict a sudden market downturn or an unexpected scandal within a company. That's the risk. But then there's the reward. For the farmer, it's a field full of ripened crops, ready for selling or replanting. For the investor, it's the growth of their initial investment, the dividends they receive, or the increase in share price when they decide to sell. Investing, like farming, is a balance of risk and reward. You risk your initial investment with the hope of a greater return. The higher the potential return, the greater the risk. It's a delicate dance, but one that can be incredibly rewarding if done right. The key is in understanding that risk is inherent in investing. Every investment carries some level of risk, but with knowledge, research, and a keen understanding of the market, you can manage that risk and make informed decisions. Benjamin Graham, often hailed as the father of value investing, once said, "The essence of investment management is the management of risks, not the management of returns." This underscores the importance of understanding and managing risk in your investment journey. Just as the farmer doesn't plant his seeds haphazardly, but rather plans, prepares, and makes informed decisions based on weather patterns and soil conditions, so too must an investor approach the share market. In the world of investing, no risk often means no reward. So be like the farmer. Understand the risks, plan for them, and reap the potential rewards. Ever heard the saying, "Don't put all your eggs in one basket"? It applies to investing too. Just like it's not wise to risk everything on a single venture, it's equally imprudent to stake all your money on a single stock. That's where diversification comes in. It's the practice of spreading your investments across a variety of assets to reduce risk. When you diversify, you're not relying on any one investment to carry the load. Picture your investment portfolio as a balanced diet. If you only eat pizza, sure, it's delicious, but it's not going to provide all the nutrients your body needs. You need a mix of proteins, carbohydrates, fruits, vegetables, and yes, maybe even a little pizza. Similarly, a diversified portfolio includes a mix of different types of investments like stocks, bonds, real estate, and cash. Each type of investment has its own level of risk and reward, and by mixing them together, you can create a balanced financial diet that matches your appetite for risk. Let's say you've invested all your money in the tech sector. If the tech industry takes a hit, your entire portfolio is at risk. But if your investments are spread across different industries and asset types, a downturn in one area might be offset by gains in another. This doesn't guarantee you won't lose money, but it can help manage the risks. Diversification isn't just about spreading risk. It's also about increasing potential returns. When you diversify, you're able to take advantage of growth in different sectors and markets. You're not just banking on one horse to win the race, you're betting on several, each with their own odds of success. Remember, diversification is not a one-time task, it's an ongoing process. As market conditions change, you may need to rebalance your portfolio to maintain the right mix of assets. Diversification is your buffet in the world of investing. It offers a variety of options for your financial palate. So, don't limit yourself to just one dish. Explore the buffet and enjoy the flavors of financial success. Let's peek into the playbook of some of the world's top investors like Warren Buffett and Benjamin Graham. When it comes to investing, there's no one-size-fits-all strategy. However, we can learn a lot from the approach of those who've successfully navigated the market's turbulent waters. Two such individuals are Warren Buffett and Benjamin Graham, considered titans in the world of investing. Both Buffett and Graham are proponents of the value investing strategy, a method that involves buying stocks of companies that are undervalued by the market. But what does it mean for a stock to be undervalued? Well, it's when the market price of a company's shares is lower than its intrinsic value, the actual worth of the company based on its fundamentals. Now, how do these investors determine a company's intrinsic value? They don't rely on market trends or hot tips. Instead, they dive deep into company financials, assessing aspects like earnings, cash flow, and debt. They also consider factors that are harder to quantify, like the quality of a company's management team. Warren Buffett, for instance, is known for his meticulous approach to selecting investments. He looks for companies with a competitive advantage, or what he calls a moat. This could be a strong brand reputation, a unique product, or even a monopoly in the market. Benjamin Graham, often referred to as the father of value investing, focused on safety margins. He recommended buying stocks when their market price is significantly lower than their intrinsic value, providing a cushion against potential losses. It's important to note that this strategy requires patience. Value investing isn't about quick wins or overnight success. It's about long-term gains. It's about buying a dollar for 50 cents and waiting for the market to realize its true value. Investing isn't about following the herd. It's about finding value where others don't. So next time you're considering an investment, think like Buffett or Graham. Look beyond the market price and try to uncover the true value of a company. Because when it comes to investing, the real opportunity lies in the places others overlook. Hello, my friends. Before you click off the video, I want to say one thing. Thank you so much for watching to the end of this video. You reaching this point is hopefully proof that I've provided some kind of value to you in some way or another. So be sure to hit the like button. If you want to see more videos around the topics of business, money, and finance in general, then be sure to hit the subscribe button. But with all of that being said, my friends, I hope you have a wonderful rest of the day. I will catch you in the next video. Thanks. Join us in our next video where you will find the steps to achieve financial independence. See you there.